So what are contracts for difference? They're an agreement between two parties which allow you to make a profit or loss by reference to price fluctuations in an underlying instrument or security. That's a very technical definition, so we'll get into the meat and guts of our session. What is a CFD? It's an instrument that lets us trade a price difference. Contract for difference trades a price difference. We can trade the market in either direction, up or down, and it's extremely important to be able to trade the market in any direction. My company that I run is a company called DIY Hedge Fund. You will see our standout there. It's another business that I have. And one thing I'm extremely passionate about is empowering people to take control of their financial management. But not just take control of it, to be able to run their own money like a hedge fund, hence the concept of DIY hedge fund. What does a hedge fund do that retail people don't? Well, it trades the market in various directions, up or down or sideways. It trades various instruments, equities, options, futures, foreign exchange, and CFDs, perhaps. And being able to combine those skills in a way where your stock selection is finessed to a level that enables you to get consistent low volatility returns is why, and you would recall the charts that Stephen Jennings shared with you on some of the bigger hedge funds in the States, why they outperform year in, year out. That's what your equity curve needs to look like. By the way, I just threw equity curve in there. Who's got an equity curve at the moment? Who hasn't? We're all going to play this game today. Someone's got sweaty armpits as well. Look, you've got to have an equity curve, just like you've got to have a trading plan, because if you don't know where you are, how the hell are you going to know when you get there? If you got on a plane like I did this morning, and they've done the safety drill, and the captain comes on and goes, "Hey guys, how are we going? Captain so-and-so, welcome you aboard. Look, we've just taken off, and I just want to let you know now, I'm not sure where we're going, or when we get there. In fact, I don't actually know how much fuel we've got on board either, but rest assured when we run out of fuel, we will be landing somewhere. It may not be voluntarily, but we'll be landing." How confident would you be about flying there again? Anyone want to join that frequent flyer program? I mean, my landing this morning, I swear to God, I thought we crashed. I didn't think we landed. It was like an aircraft carrier landing. Boom, we were there. But the seriousness of what I'm just saying is, you wouldn't get on a plane with someone like that, so why would you manage your portfolio like that without an equity curve that tells you where you're at? By the way, an equity curve is a chart that looks something like this. This is time, and this is the dollar value of your portfolio. And sure, we'd all like it to be a bottom left to top right. Ideally, it's going to look something like that on the grind if we smoothed it out. Now, it's more likely in reality to look something like that, isn't it? But overall, we can see that we're building our wealth. Now, if you don't know what your equity curve's like, how do you know how good a trader you are? And we're all excited about leveraged instruments, yet we don't know how good a trader we are? That's getting a bit scary, isn't it? Now it's really gone quiet. Gee, guys, what have I done? Get the defibrillators. You don't want to have an equity curve that looks like this. You know, that's Luna Park stuff. We're not into that in the market. We're in there to make consistent returns over time. We'll come back and talk about that. Open-ended timeframes is something that's extremely exciting about CFDs. We can use leverage, and the great thing about, particularly with the platform that we have, it covers 19 different exchanges globally, so we can get exposure to the US market, or the Japanese market, or the European markets, or the UK market, wherever it might be, as well as the top 200 stocks here, plus futures and other commodities on there as well. Very, very powerful instrument. Simple example, by the way, CFDs are a derivative. That means their price is derived from an underlying asset. That's all a derivative means. They're synthetic. There's no tangible asset behind it. It's not like a share where you have a share in a business. It's an intangible. It's a derivative. So let's say we're bullish on a view, and this is pretty obvious. Generally speaking, if you're bullish on a stock, you buy the share or the CFD. If you're bearish on the stock, you sell the CFD. Who's with me so far? It's pretty basic stuff so far, isn't it? Well, we'll see how we can take this view going forward. An example, if we just want to put some numbers to it. If we're going long, isn't the market funny? We use these words like long and short and naked and covered. You know, it sounds almost perverted, doesn't it? If you say, like, I'm naked and long, I mean, you've got to talk to your broker. I'm naked. You imagine the day when you've got a video phone and you're on a conference call and you said, look, I'm naked and I'm long, and you go, no, mate, that's short. You're not long. Chunk, end of conversation. Are you interested? That's better. We're warmed up. It's easy, isn't it? What we're looking if we're going long, no dirty laughing now, buying an initial price, and what we're looking is to buy at one price and sell at a higher price, effectively. That's very simple, isn't it? It's a simple rule of thumb. If you're trading and your share prices are doing something like this, you want to be buying here and selling there. And if we bought at $4.95 and sold at $5.40, lo and behold, we've made a unit price of 55 cents. The key thing, what we're talking about here, and we'll keep coming back to this, is price difference. Because CFDs relate directly to a price difference. How many people here have traded options or have had some exposure to options? That's terrific. Now, how many people have ever bought a call and the share price has gone up, but the call has gone down in value? You think, gee, how did that happen? It's not supposed to go like that. Something called time decay, isn't it? Theta. We'll talk about that as we go on. You don't have that problem with CFDs, which is a great thing. Similarly, if we're going short, we're selling at an initial price and we're buying back, so we might be selling up here at a high price and buying back at a lower price. Selling at $8.52, buying at $7.26, the profit margin or the price difference is $1.26. It's, again, fairly simple, isn't it? So that's how a contract for different works. What I've done here on the screen, what I've done is just grabbed a spot price in the market. We're just looking at Amcor, and what we can see is the market on Amcor is trading, gee, has anyone else got the shakes, or is that just a little bit shaking around on the screen there? Give you a bit of a headache looking at. The price on there we're looking at with Amcor in the market, the share price is $6.95 bid, $6.98 offer. So there's a bid-offer spread of about 3 cents. What we can see lower down is the fact that the price of the CFD, we just look over here, or on the other side there, if you look at the green boxes, 695.6, 699.4. So the price of the CFD, the price of the underlying share, you can see they're very, very closely related. In other words, if that's the share price, the CFD price is going to be extremely close to it. That makes sense? Because you're trading the same thing. It's just not the actual share. You're trading a synthetic version of the share. We'll come back and look at that in a moment.